When we talk about the startup world, the first thing that comes to mind is often venture capital. We imagine bold investors pouring millions into the next big thing, the next Google, Facebook, or Uber. The narrative is simple. VC funding equals fast growth, big ideas, and eventual massive success. But what if I told you that venture capital is actually toxic for many good startups? What if this supposed engine of innovation is actually hurting the very companies it claims to support? You see, in the world of venture capital, it's not always about creating sustainable, long-lasting businesses. In fact, for many investors, it's about maximizing returns as quickly as possible, regardless of the consequences. The pressure to scale quickly, the relentless pursuit of exit strategies, and the focus on short-term profits can all lead to toxic behaviors that undermine the very essence of entrepreneurship. Now, before you start thinking I'm just bitter or anti-capitalist, hear me out. I'm not saying all venture capital is bad. Some startups truly benefit from the funding, mentorship, and networks that VCs provide. But what I am saying is that for a significant number of startups, venture capital can be more harmful than helpful. Take, for instance, the story of Theranos, a company that promised to revolutionize healthcare with a simple blood test. In the early days, the company received millions in VC funding from some of Silicon Valley's most prominent investors. But despite the hype and the big promises, the technology didn't work. Yet, venture capital continued to flow, pushing the company to scale rapidly, to pursue more funding, and to create a business model that was ultimately built on lies. Theranos isn't an isolated case. We've seen this pattern with many other companies, WeWork, Better.com, and Quibi, to name a few. Each of these companies raised massive sums of venture capital, only to implode when their business models couldn't sustain the rapid growth that investors demanded. In each case, the focus was on scaling at all costs, chasing valuations, and creating an exit opportunity, rather than focusing on building a solid, sustainable business. So, what exactly is toxic about venture capital? Let's start with the most obvious issue, the pressure to scale too quickly. When a startup raises venture capital, they often face immense pressure to grow rapidly. It's not enough to build a great product or offer a service that customers love. VCs want to see exponential growth, preferably with a clear path to profitability in the shortest time possible. This is where things go wrong. Fast scaling means rushing through crucial early stages. Founders are often pushed to hire too quickly, expand too soon, and enter markets they're not prepared for. The result? Poor execution, operational chaos, and a business that collapses under the weight of its own ambition. Consider Snapchat, for example. When it first launched, it was a simple app that allowed people to send disappearing photos. It wasn't a groundbreaking idea, but it had a loyal user base. However, as Snapchat raised venture capital, it felt the pressure to scale massively. The company added features like stories, filters, and a marketplace. These features didn't come from user demand, but from the pressure to compete with larger, better-funded companies like Instagram. The result? Snapchat became a bloated platform that lost its original charm. Users who once loved its simplicity were now overwhelmed with new features they didn't want. Snapchat, which could have grown organically, was forced to chase the latest trends to meet investor expectations. Another major problem with venture capital is the obsession with exits. In the VC world, the ultimate goal is often not just to build a company, but to sell it or take it public at the highest possible valuation. This pressure for an exit leads to risky decision-making. Founders, driven by the desire for a big payday, are pushed to make moves that might not be in the best interest of the company or its long-term growth. Take WeWork, for example. The company's valuation skyrocketed when it was positioning itself as a global leader in co-working spaces. But when the company's business model was scrutinized more closely, it became clear that WeWork was losing money and wasn't nearly as profitable as it appeared. The pressure to go public and secure an exit led to a situation where the company was grossly overvalued, and eventually it collapsed. In fact, exit pressure isn't just a problem for high-profile startups like WeWork or Uber. It affects all kinds of businesses, particularly those that don't have the resources or experience to manage that pressure. Startups can end up compromising their integrity and their values just to make the numbers work for an acquisition or IPO. Venture capital's emphasis on exits also distorts the long-term vision. The focus on a quick sale or IPO means that founders are incentivized to prioritize short-term growth over long-term sustainability. This mentality often leads to companies making short-sighted decisions that hurt their future prospects. They might cut corners on product development, focus more on marketing than innovation, or neglect their company culture, all in the name of growing quickly and meeting investor expectations. One key example is Better.com, the mortgage company that faced backlash after laying off 9% of its workforce over a Zoom call. The company had raised significant venture capital, and the pressure to perform and show growth clearly influenced its decision-making. In the pursuit of rapid scaling and profitability, the company ignored the human side of business. This move led to a public relations nightmare and damaged the company's reputation. So, what can startups do differently to avoid the toxic side of venture capital? The first step is to focus on sustainable growth. Instead of obsessing over scaling at all costs, entrepreneurs should prioritize building a solid foundation. They should focus on their product, their customers, and their team before worrying about rapid growth. Sustainable growth means focusing on long-term customer relationships and building a business that can weather economic downturns or market shifts. This doesn't mean avoiding venture capital altogether. In some cases, VC funding is necessary to fuel growth and scale, but it does mean that founders should be selective about the type of investors they bring on board. Founders should seek out investors who are aligned with their long-term vision and values. Investors who understand that building a business takes time and are willing to support founders through the inevitable ups and downs of entrepreneurship. Founders should also be wary of the unrealistic promises that some VCs make. While VCs often tout the potential for massive returns, they rarely talk about the risks that come with that kind of rapid scaling. Entrepreneurs should ask tough questions about the terms of their investment deals and make sure that their investors are truly there to support them, not just to push them toward the next exit. Another critical aspect of building a successful startup without the toxicity of venture capital is creating a strong company culture. Many startups fail because they don't prioritize culture. They hire quickly, onboard employees hastily, and then wonder why their teams aren't performing. A good startup needs a culture that fosters innovation, accountability, and collaboration. A toxic culture can erode a business from the inside, leading to high turnover rates, burnout, and poor morale. Lastly, startups should focus on creating a business model that doesn't rely on endless funding rounds. While raising venture capital can help fuel growth, it should never be the only source of revenue. Founders should think about how their company can generate cash flow early on, whether through product sales, partnerships, or other revenue streams. This independence will help them avoid the pressure to constantly raise more money and will allow them to build a more sustainable business in the long run. The future of startups in the age of venture capital. As we look to the future, the landscape for startups is changing. The era of endless venture capital funding may be coming to an end, particularly as investors begin to realize that not every company needs to scale at breakneck speed. More and more, we're seeing startups that are bootstrapped, lean, and focused on profitability from day one. These startups are less reliant on outside funding and are building businesses that can survive without a massive exit. The rise of alternative funding options like crowdfunding, angel investors, and revenue-based financing is also changing the game. These models allow founders to raise capital without giving away large portions of their company or giving in to the pressure to scale quickly. This shift may create a more sustainable, healthier startup ecosystem. one that values slow and steady growth over unsustainable speed. Ultimately, the lesson here is simple. Venture capital is not a one-size-fits-all solution. While it can work for some companies, it's not always the best path for every entrepreneur. By focusing on sustainable growth, building a strong culture, and avoiding the toxic pressures of rapid scaling, startups can build businesses that last.